Well, thank you very much for doing this. I appreciate it.
Thank you.
It strikes me as I look at the world today where there is broadband and 5G and refrigerators are connected to the internet and I can watch any game I want on my phone, that we tend to forget what underpins all of that, what gave birth to all of that. And that's the work that you and others did really just a few decades ago, stringing coaxial cable around towns and cities around this country. As you look back on that, what you were doing then and sort of where we are today, what do you think of that arc of progress?
I just think evolution of technology is unstoppable and accelerating. So when I look at it, having been an electrical engineer, sort of coming out of Yale, the digit in those days was a toroidal core with a wire wrapped around it. By the time I got through at Bell Labs, working at Bell Labs, we already had integrated circuits. My doctoral dissertation was artificial intelligence. So these technologies have deep roots, but the technologies available have paced really the industry. And cable was the first high-speed mechanism after broadcast.
I don't want to say that TV is in your DNA. I think it's more nurture than nature, but your dad worked at General Electric on television's a very seminal moment in their development. Was it that got you interested in all of this to begin with? What got you into cable, made you think it was something where there was a lot of promise?
Luck. Just luck, really. Even when I went to college, I didn't know what I wanted to major in, but I was better at engineering, and so I took engineering and economics. And then, once again, I wanted to get married at that point, and I wanted to go to graduate school, but I couldn't afford it, and I didn't want to be a burden on the folks. And so I went to work for Bell Labs because they would send you to graduate school and pay for it, which allowed me then to get married and go to graduate school. And so the Bell Labs was, of course, engineering, science, a little bit of modeling. They wanted me to take a subject called operations research. Johns Hopkins was the only place that had a program in that at the time. So that's where I went. I went where I could afford to go, okay? And I did have interest and thought I might be good at it. And then the PhD was just a continuity of that same theme. That put me into a certain category at AT&T. Got involved in modeling the AT&T system, really for the board of directors. Went on to McKinsey, consulting for technology companies. McKinsey wanted to recruit people who had a technical background, and theoretically I did at that point. Consulted, did some big projects with IBM, General Electric, restructuring, Jack Welch, all of that. Ended up consulting for a company that offered me a job. Took the job. That put me into cable TV.
You write at the beginning of the book about a moment when a huge amount of pressure is on you and this company because of mounting debt.
Right.
And it gives you a new awareness of or perspective on risk.
Yes.
Could you talk a bit about your approach to it? Because when I look at you in complement with other folks in your line of work, Elon Musk, Ted Turner, it seems to me you approach risk in a different way.
Well, first of all, I was stupid to take the job. Okay, having taken the job and made the bet, then your total focus is on survival. So we spent 6 years where I was, about half my time was traveling, keeping banks quiet, and the other half was keeping cities quiet, because all kinds of commitments had been made, and the funding just wasn't available. And in truth, the service for the public was not yet developed enough. So the industry had a very bad false start in the 70s. By the end of the 70s, Stationary satellites had provided the industry with scale, with the capability to have scale, and to deliver differentiated content. And that is really when the industry took off. Because once we had a product the public wanted, the funding became available, and then it became a race for scale. And the job became, having outrun the bank debt at that point, survived, and then starting to outgrow your debt, something I see Trump trying to do now. It was then, can you get big enough, fast enough to have scale advantages? And you were competing really not so much directly with your fellow cable guys, because this was a territorial monopoly, basically. If you got, in those days, if you got a franchise, then you were essentially the sole provider in that community for probably 15 years. And so the faster you could accumulate that, the more leverage that gave you over the content suppliers, because you were became an important customer. And the more important customer, the better deal you could cut, the better economics you had to go do the next acquisition. And we found ourselves doing an acquisition about every 2 weeks.
Every 2 weeks.
About every 2 weeks on average. Some were large, and I would personally do, and many of them were virtually pro forma. As long as they could check the box, we delegated the ability to buy the guy next to you. And so that was great, and I think I made the comment, it's the most fun in life, in business, is to have a monopoly, which we were, sort of. Now, so was every cable operator, I have to say, in his territory. By the early 90s, the government was tired of us being a monopoly, and we had created enough pushback from others, content providers and so on, that there were various efforts at regulatory rein-in, let's say.
You mentioned scale a moment ago, economics of scale. That was certainly the driving factor at the beginning. As you look at sort of how you've built your portfolios over the years since, is that still your biggest motivators, or how have you approached growth?
Well, first of all, I had a great mentor early, Moses Shapiro at General Industry. He was the chairman. And he was a tough old bird, but he would teach me about the Talmud. Okay? And he said, one of the things the Talmud teaches you is ask yourself the question, if not.
If not.
If not. So if your model, if your business plan works, great. But ask yourself the question, well, what if it doesn't? What if your assumptions are wrong? What if this doesn't work or that doesn't work? Where are you at that point? What's the downside? How much risk are you really taking? So you really try and look risk very hard in terms of how you finance something. Do you have partners in it? The government's always your partner from a tax perspective, so don't forget that you can deduct your failures from your successes. Don't ever get to where you can't. You're going to have lenders. If they have risk, they're going to help you make sure that you're not taking too much risk. So they become good partners in assessing risk. And if you structure it properly, if you do get in trouble, they're buying lunch, you're not, right? Kind of an attitude. Don't ever count on anything being for sure. And so that has colored the structure of the organizations that I've put together over time. So a typical thing for me would be no debt at the parent. Subsidiaries would be levered rationally but substantially, particularly if there's tax or other advantages. And so the parent was always in a position to rescue the subsidiary, but never in jeopardy of a single torpedo, a single bad thing taking it all down. So risk avoidance coming out of the TCI survival, I think, was the #1 lesson that I learned. Diversify, never cross-guarantee, Never consolidate liabilities unless you're really, really comfortable. Just to get an eighth of a point better deal on your financing, don't go there. Try and isolate your risk. We even came up with a strategy called the outhouse theory. If you're going to do what you regard as an uncertain acquisition, buy it into a standalone capital structure. Be willing to pay whatever the debt risk represents. Make sure you can refinance it timely if it works. And if it doesn't work, structure it so it doesn't poison the whole barrel of apples. So it's sort of a way of isolating risk and making sure you have partners in your failures.
We could talk about any number of successes, but let me ask you about Sirius XM, where you made an incredible amount of money on that bet and on that investment. And in the book you write, the way music is owned and monetized is undergoing continuous evolution, and that's fertile hunting ground for Liberty Media. Stay tuned. Yeah. Begs the question, where do you see opportunity in that space today? A
couple of points I want to make there. First of all, on Sirius XM, we were an early founding investor in XM. But when we saw the competitive environment emerge, we got out of it. Mm-hmm. Then we got the phone call that said, are you interested in Sirius? They've had their deal with XM approved for merger, but we're in the middle of the financial collapse. And Mel's financial commitment is from Lehman Brothers. And we think Mel has a choice of bankruptcy, giving control to Charlie Ergen, or looking for a savior. So we stepped up, Greg and I stepped up to be the savior. And we said, we don't have to have control, but we want options for 40%, cheap options, and we'll loan you enough money to get you over the hump. And it worked out great. So that was a great transaction. Music now has moved on. There's been a lot of competition in electronic music. A lot of big players. Sirius has done well in the auto, and okay in the random access on the internet, but with Pandora. But the home run in music, frankly, is Live Nation, live performance. In a world of random access, where you can basically have anything at any time and generally affordable, live has become a very important component. And so I think the big upside for us at this point is with live, with the 32% that our shareholders own in live. Are you
a Howard Stern fan? Are you watching this controversy over his contract renewal with any acute interest?
I think they go through that every 5 years. In order to do the spinoff of Sirius, I gave up my control position in the company. I just took the same deal every other shareholder got. That made the special committee on the board happy, made the deal doable, frankly. And so I'm just a shareholder of Sirius. And so I don't really know much more about it than you do.
You categorize Rupert Murdoch as someone you have been friends in business with and occasionally kind of a corporate adversary of. And I wanted to ask you just about why you think the Fox News channel has been successful as it has been. Well,
I can tell you, Rupert called me up. I was already heavily in television news at TCI, right? We had McNeil Lehrer, which we actually owned. We owned, I think, 80% of it.
You're a big fan of the NewsHour.
Yeah.
Yeah. And
we supported that in the public interest. I had helped start CNBC with the GE guys. And we were a financial partner in it. A strange structure, but we were a financial partner in it, which we were up till about 4 or 5 years ago. And we had bailed Ted Turner out. Not only did we carry CNN, but when he got in a little bit of financial distress, we had rescued him from Kirk Kerkorian. So I was pretty heavily involved, and I was on Ted's board then from that point forward. So I knew that side of it. Rupert called me up and he said, John, do you think there's a place in America for another video news channel? And I said, in all honesty, Rupert, I think if you came down on the conservative side of the middle, right, I think there is an appetite for a video news service because TED and CNN are tending to go a little more liberal, both culturally and politically. And I think if you come down, and I said the reason I think that is Rush Limbaugh has got a massive radio audience. It's extremely loyal. And he mixes politics with humor, and he's been very successful. And I think that's just an indicator to me. And then, of course, I put my financial hat, after giving up the advisory role, I put my financial hat on and said, you know, we'd be happy to carry you, but we need an economic interest in its success. And so we cut a deal that we had warrants to purchase 20% of Fox News at whatever the net invested capital was at the time we chose to exercise that warrant. And that was the deal. And he said, well, why don't you go talk to Limbaugh and see if we can make him our anchor? And I did. I had 2 delightful luncheons with Rush, and I was unsuccessful in talking Rush into going on television again. He had tried it earlier. But he suggested Roger Ailes would be the perfect guy to head up the effort for Rupert. And so we recruited Roger, and he did a fabulous job. But the deal from the beginning was, this is going to be successful because it's a hybrid of entertainment and news. We're going to have a serious news component, but we're also going to have entertainment focused on culture and politics, right? And we will have celebrities. Ted had always said no celebrities on CNN. Didn't want to pay for them, didn't think they belonged. He wanted a pure news. And so Fox launched, and it was, of course, successful. And because it doesn't have meaningful video competitors, it's got a substantial scale, substantial enough to make it quite a valuable asset.
We're at this moment where Newsmax is suing Fox News, alleging that Fox News has used hardball tactics. And I thought of how in the book you detail how Fox News at the beginning was paying distributors to carry the channel. Mm-hmm. There's also this kind of delicious inversion of what's happening here, which is Rupert Murdoch sued Time Warner, if I remember correctly, for not carrying the station in Los Angeles and New York.
Correct.
What do you make of that suit? Do you see any foul play here, or is this just kind of a continuation of the tactics we've seen kind of the Murdoch enterprise use from the beginning?
I think, the issue of exclusivity in carriage and bundling, to me, okay, I got to take you back a notch. There was a time when John McCain, who, by the way, was a terrific human being and a great senator, he sponsored the concept that programming above a certain cost should be a la carte, right? Which I wholeheartedly believed in. And his idea was his grandmother is paying for a lot of sports she doesn't watch. And so if anything over 50 cents a month was going to be on, that it should be on optionally as an a la carte service, which I totally believed in. We could not convince the bulk of our industry to get behind McCain and support him. He called me up one fateful day and he said, John, I'm not going to be Don Quixote here. Okay. He said, I can't do it if your guys aren't going to support me. And they didn't. And I think that was the beginning of the end, frankly, of the cable industry's success as a video distributor.
It's funny because in the book there's a chapter in which you say you're surprised the DOJ never went after cable bundling.
At a bundling.
And yet I think of you as the father of the cable bundle and somebody who's decried a lot of government regulation. So just to explain that to me, your surprise and why it sounds like you might have been in favor of that happening.
Oh, yes, we bundled, of course, but the ability to a la carte in order to control cost, to me, was an essential ingredient. And what happened to the industry was that once these big guys could bundle, you couldn't say no. And so there was never a successful new cable channel that wasn't owned by somebody who had market power, okay? And the crime for the cable guys was allowing their video bundle costs to get so high. You start charging $100 a month, when I was chairing DirecTV, I don't know what the numbers are now, but we were up to $118 was our charge for service, base service, just for content, right? Just for the delivery of linear video content. And it was at a point when a big percentage of Americans couldn't afford it. So Netflix succeeded really because the big bundle was way too expensive. And everything, you bought it all or you didn't get any of it, right? Which to me was suicidal for the industry, especially as sports bidding became so aggressive. It just drove the cost of the bundle and therefore the retail price, through the roof. And I think Netflix just found it easy to look really cheap with a great, well-engineered random access service at $8, I think is where they started. So I think we just, as an industry, got caught ourselves with a product that was just too highly priced with too little margin. And we had no power over the Disneys or Foxes of the world to force them to hold down their cost or to separate their product.
Let me ask you about Warner Brothers Discovery. This is a merger that you were enthusiastic about and advised on from the beginning. You're an emeritus member of the board now. There was some news yesterday. The CFO of the company saying there could be a 20% equity stake available in the kind of streaming and studio side of the business.
That was the originally announced deal, right?
Who do you see as a buyer of that? Where would the interest be in that kind of equity stake?
Public investors.
Public investors.
Yes. I think that the reality is the Warner studio library and rapidly growing streaming business will have a much higher valuation, okay, than the combined company, or than it is attributed in the combined company. And the reason is it's over-levered. You have a declining linear video business, right, which despite best efforts is still declining in both its advertising revenue and its affiliate fees. And you have a growing streaming business that David has done a great job of turning around and now profitable and probably nicely growing. I think the public investors, institutional investors, will value that quite highly. That growth and that potential, once that, I laugh about it, but once that pickle is out of that jar, okay, there are going to be a lot of people interested in doing business deals with that pickle. It's very difficult to buy a declining business or to put a real high value on it. So my assessment, once we got into the merger, was that we should try and outrun the debt. And so David did a great job of generating free cash flow, and we paid down a lot of debt. I think $25 billion out of operations, while still trying to grow the streaming business and reinvigorate the studio. And we just couldn't outrun the rate of decline of the linear business. And to break out, we needed to raise equity. And so the board had quite a long debate about the most efficient way to raise equity. And we could have done a rights offering with the stock at $8 and maybe sold some equity at $6, extremely dilutionary. Or we could basically believe that that separated unit, modestly levered, would be highly valued, and therefore 20% of it would provide enough equity raise, okay, to be able to give headroom to the linear business to be able to modify itself and take advantage of its opportunities, which we see more as moving in the direction of broadcasting and global as opposed to domestic. So that's it. People ask me, was I stupid to do the Time Warner deal? And the answer is, Discovery, while it was doing great, was facing exactly the same future that Warner Brothers was. We were both confronted with having to make a transition to a new technological platform and a completely different form of consumer behavior. And Discovery would have found itself way too small in that trajectory. I mean, you can look at a number of other businesses that didn't do a deal that are still trying to be linear. And they're trading at 1x EBITDA. I mean, their evaluation by the market is as if they're already death sentenced to zombies, right? So we knew Discovery needed to do something. And we had tried. We'd launched our own streams, and they were modestly successful. But we were not going to be able to go up against the big guys who were increasingly Netflix, Amazon, Google, YouTube, with deep pockets, global presence, unless we were bigger. So once again, it was a scale-driven decision. Whether or not there was adequate diligence at the time, keep in mind, it took us, I think, a year and 3 months to finally get government approval, during which we were not allowed to do diligence in any meaningful way. We had to rely on public documents only from the Discovery side. And so the fact that the streaming business had not lived up to its early, and that AT&T had spent a fortune converting HBO into a streamer, unsuccessfully, I have to say, taking a $2.5 billion positive cash flow to $2 billion negative over that time frame. So we walked into a rapidly deteriorating economic situation, which I guess if we had been prescient enough, we would have anticipated, but we did. So we got a great team. Zaslav's the best. I don't know where he gets the energy. I think we're going to make it work. I think both companies actually are going to turn out to be pretty good. I'm still a big shareholder. I haven't sold any shares. But it's going to be a challenge. I mean, it is not a lay-down hand. And I think the whole industry is going through this same transition. And I point out for the folks who are interested in CNN that AT&T announced the CNN Plus. And they spent a fair amount of money trying to get geared up for it. We looked at it, I looked at it as a distributor, and I said, shut it down, shut it down. It's a dead loser. Why? It doesn't include CNN. So I'm going to subscribe to a streaming service called CNN, but it doesn't have CNN? Come on. Well, why doesn't it have CNN? Well, because CNN is tied up in a whole bunch of distribution contracts that would make it a breach of contract for them to have included it. And so that was the other, of course, learning lesson that I don't think AT&T understood, that a lot of the intellectual property in Warner Brothers was already licensed internationally. If you actually had sat there, and even last year, and looked at the economics of Netflix in the US and the economics of HBO in the US, they look almost identical. One trades at 200 billion and the other trades at 20 billion. I mean, it's about growth, right? Future. And so it's taken David this long before he can extricate a lot of his best programming from contracts that pre-existed the deal. So, for instance, countries like the UK, Sky in Europe, which is the UK, Germany, Italy, Austria, Switzerland, and maybe some others. They all have licenses for the best Warner Brothers product that go for another year or so. So you had to outweigh those before you could actually launch. Because the real secret of Netflix is global, is international. 70%, I believe, of their customers are outside the US, and that's where the growth has to come. And we think Discovery's brand, which is well known, combined with Warner Brothers content, which is pretty well known, should succeed in growing internationally much faster than people generally think.
Last question. In the book, you address legacy and retirement. You write, retirement is going to be an imperceptibly slow transition. Yeah. Is it happening? Are you simplifying the business? I see you shying away from it.
You sound like my wife. She says you've been telling me you're going to retire since you were 30. No, it is slow because I've been involved in so many things. To me, retirement is primarily extricating myself from the public corporate roles that I play, board chairman and so on. I have a ton of private businesses that I'm still going to be involved in and that are sort of my meat and potatoes. Everything from ranching, farming, forestry, multifamily, horse racing. I got a lot of things that I'm still saying grace over. And I intend to continue with my control positions in the various enterprises from which I will be slowly leaving the boards. So I left 2 boards this spring. I probably will continue this process. I think I'm still on 4 public corporate boards, at least 4. But so I'll be slowly backing away as very capable people take my place. I'll continue to be a big shareholder. In some cases, I'll be at least regarded by the government as control, which is, by the way, a commitment because it makes you illiquid. Mm-hmm. So I typically go into this emeritus kind of role like I was with Charter until the Clayton Act, which I don't think was right, but they kicked me off of Charter. I had to choose between Warner and Charter. So as I slowly, shrink, so for instance, a good example would be the Charter position itself, which we hold through a holding company called Liberty Broadband, is going to merge into Charter, and therefore that role will disappear of being a control shareholder of a control company, right? So I'm moving the pieces to back away, and then I've got a couple that I might stay involved in to try and recreate a Liberty type of model, because I still think corporate architecture is very interesting. And some of these things, alphabet stocks and tracking stocks and other perceptions that I have about value creation are still fun to play with. And some of those have to be in a public forum. So that's retirement for me.
John, thank you very much. Great to speak with you.